Imagine trying to save a dying engine. You add more fuel. Nothing happens. You add even more. Still nothing. Eventually, you realize the problem was never the fuel. The engine itself stopped responding. Modern economies can experience something remarkably similar. Central banks lower interest rates. Growth remains weak. They inject liquidity. Investment barely responds. They create unprecedented amounts of money. Consumers remain cautious. Businesses delay expansion. Banks hesitate to lend. From the outside, it appears impossible. How can an economy receive more money, yet fail to accelerate? Because money alone has never powered economic systems. Confidence does. Money simply follows confidence. And when confidence disappears, even the most powerful monetary tools begin losing effectiveness. Economists call this phenomenon the liquidity trap. Today, we decode one of the most misunderstood failures in modern economics, the moment when printing more money no longer works. Under normal conditions, modern monetary policy follows a relatively simple architecture. Economic growth slows. Central banks reduce interest rates. Borrowing becomes cheaper. Businesses invest. Consumers spend. Banks extend more credit. Economic activity accelerates. The process resembles lubrication inside an engine. Lower borrowing costs reduce friction. Capital moves more freely. Investment becomes more attractive. Employment expands. Consumption increases. The system reinforces itself. For decades, this mechanism became one of the most powerful stabilization tools available to governments. When recessions appeared, central banks responded, often successfully. But hidden inside this architecture exists an assumption. People must actually want to borrow. Businesses must actually want to invest. Banks must actually want to lend. Without those incentives, the machinery begins slowing. Imagine offering someone an almost free loan. Normally, they would accept immediately. Now imagine they believe the economy will deteriorate. Customers may disappear. Revenue may decline. Jobs may become uncertain. Suddenly, even free money appears expensive. Because the decision is no longer about interest rates, it is about expectations. This is the heart of the liquidity trap. The financial system contains abundant liquidity, yet participants voluntarily refuse to deploy it. Consumers increase savings, businesses postpone investment, banks tighten lending standards, investors seek safety rather than opportunity. Every participant behaves rationally. Collectively, their caution slows the entire economy. Notice what changed. The supply of money increased. The willingness to use money decreased. The architecture broke, not because liquidity vanished, because confidence did. Many people assume creating more money automatically creates more growth. History suggests otherwise. Money is a tool, not an objective. Suppose every bank suddenly holds abundant reserves. That alone guarantees nothing. Loans require borrowers. Borrowers require confidence. Confidence requires expectations of future opportunity. Without demand, credit remains idle. Without productive investment, economic activity struggles to expand. This distinction separates liquidity from prosperity. Liquidity creates potential. Demand converts potential into production. Production creates income. Income supports consumption. The chain depends upon participation. Breaking one link weakens the entire system. Printing money strengthens the first link. It cannot guarantee the rest.
Complex systems often create feedback loops. The liquidity trap is one of them. Consumers worry about employment. They spend less. Businesses observe weaker demand. They reduce investment. Banks detect higher risk. They approve fewer loans. Economic growth slows further. The original fear becomes reality. Each participant responds logically. Yet together, their actions reinforce the slowdown. Architects recognize this pattern immediately. The system has entered a negative feedback cycle. Additional liquidity may cushion the decline, but it cannot automatically reverse behavior. Behavior follows incentives. Incentives follow expectations. Expectations follow confidence. Until confidence changes, the architecture resists recovery.
If money cannot solve the problem alone, what can? The answer varies across history. Sometimes fiscal investment, sometimes structural reform, sometimes technological innovation, sometimes geopolitical stability, sometimes simply the passage of time. The important lesson remains consistent. Economic recoveries rarely begin because money exists. They begin because confidence returns. People begin believing tomorrow will be better than today. Businesses begin planning years ahead. Investors begin accepting calculated risks. Banks regain trust. Capital begins circulating. The same liquidity that once appeared ineffective suddenly becomes productive. Nothing changed physically. The incentives changed, and incentives reshape behavior faster than money ever could. The liquidity teaches one of the deepest lessons in economics. Money does not create confidence. Confidence determines how money behaves. Most people study central bank announcements. The architect studies incentives. Most people watch interest rates. The architect watches expectations. Most people count liquidity. The architect asks whether liquidity is moving. Because idle capital creates very little value. Productive capital transforms economies. This is why the greatest recoveries are rarely monetary stories alone. They are stories of restored belief, restored investment, restored coordination. The central bank can provide fuel, but it cannot decide where society drives. That decision belongs to millions of individuals responding to the same invisible system: confidence. Most people think monetary policy controls the economy. The architect understands it influences the economy. The difference is profound because systems are never powered by money alone. They are powered by trust, expectation, and collective participation. This is Nexera, decoding systems, architecting wealth.